So you've been keeping a close eye on the airline industry, and you've been seeing stocks like Southwest Airlines drop 62%, Delta Airlines drop 72%, and American Airlines drop 73%. Now you might be thinking this is a great time to get in on a beaten down industry, and you've seen everything from Warren Buffett completely exit the industry and call it a major mistake that he ever invested in it, to guys like David Portnoy saying it's time to go all in because people are always going to want to fly and that's not going to go away. Now, while that might be true, that doesn't necessarily make commercial airlines a great investment. That's why in this video, I'm going to be going over how I'm going to be investing in the airline industry in 2020. How's it going, guys? My name is Aaron. I'm a value investor and trader. And if you enjoyed this video, please give it a like and subscribe so that I know to continue making content like this in the future. So let's get right into it. First, we have to take a look at why commercial airlines fail so frequently. Now, to get an understanding of why this happens, we have to look at the economics of the business. There's three key aspects that make the economics of the airline business so poor. The first is that airlines have large asset bases. And with these large asset bases come high fixed costs that they're unable to reduce during economic downturns. And the reason why they can't reduce them is because storing an airplane when demand drops is very costly for the airlines. They have to continue to run their flights, but with a lower passenger load. This creates high operational risk, which in turn creates high business risk for the industry. Following that up, the debt levels for most of these companies are above the optimal capital structure. Because with a high business risk, most of these companies' capital structure should be anywhere from 10 to 29% debt. However, a lot of them carry even more than that, which means that they can't service their debt during economic downturns. Finally, they have volatile revenues and costs, which also contribute to the high business risk. The revenues are dependent on consumer demand, and as such, they're going to be very volatile, which is something we're seeing right now with the coronavirus, as revenues for airlines have dropped 66% in just 2 months. In addition to that, their inputs are highly volatile commodities like oil and gas, and also labor makes up a large portion of their cost basis. And since they can't reduce their labor during economic downturns, this means that they have highly volatile revenues, highly volatile cost structure, and high debt levels, which means that they're a prime candidate for bankruptcy. Now in this next slide, you're going to see exactly how risky the airline industry is. This is a list of all the airlines that have went bankrupt from 1979 up until 2019. Now, while most people think that bankruptcies are limited to smaller airline companies, you can actually see that there's some major airlines on this list. At the top here, you can see United Airlines filed for bankruptcy in 2002. Air Canada, which is the fourth largest commercial airline in North America, filed for bankruptcy in 2003. And you can even see Delta Airlines filed for bankruptcy in 2005. So the riskiness of the business doesn't get better for how large you are. The industry just inherently has poor economics. And as a result, you're going to see a lot of these companies going bankrupt. And this is why investing in commercial airlines is such a poor investment. And this is why Warren Buffett decided that he's totally done with the airline industry after his second failed attempt at investing in the airline industry. So moving forward, I'm going to show you guys where I'm going to be investing in the airline industry and how I found these stocks, which are just as beaten up, or in some cases even more beaten up than the airline stocks. And the reason why is because a lot of retail investors are focusing on commercial airlines because those are very well known. However, these smaller, less well known companies provide better economics, and they've been looked over by most retail investors. And now the industry that I'm talking about is aerospace manufacturing. So there's three reasons why aerospace manufacturing is more economically viable than the commercial airspace industry. And the first is that they have stable revenues and costs. They benefit from selling both parts and servicing those parts. And as such, their stable revenues and costs lead them to having medium business risk. Moving forward, aerospace manufacturing companies also have similar capital structures to commercial airlines. However, given they have more stable revenues and costs, they're actually able to meet their debt servicing requirements during economic downturns. And finally, they have smaller asset bases compared to commercial airlines, and this reduces the risk of bankruptcy during economic downturns because they can actively reduce their cost basis by slowing down production or by laying off employees, something that commercial airlines can't do. So now, compared to the airline industry that has high business risk and high financial risk, aerospace manufacturing has medium business risk and medium financial risk, making them a more economically viable industry to invest in. And you're going to see that there's actually some great opportunities within this industry that will allow you to benefit off of the growth in aerospace and other industries. So the first stock that we're going to take a look at is Moog Incorporated. Now Moog, you can see, dropped 65% compared to 63% in 2008. And what Moog does is they're a manufacturer of motion control products. And what's actually very interesting about Moog is that they provide motion control products that landed Apollo 11 on the moon. So this company has been around for a long time and has a rich history of successful ventures. And if we take a look at their revenues, we see they have a very stable growth trajectory. And the reason why their growth is so stable is because they're able to diversify their revenues across multiple markets. And you can see at the top here that they serve more than just aircraft. They're also in construction, defense, energy, marine, medical. They're in a bunch of markets, and that helps them stabilize their revenues. And although we can see that around 50% of their revenues come from aircraft controls, 50% of those aircraft control revenues come from the military, which are far more stable than commercial revenues because the government always has enough money to continue paying their contractors. And now looking up above me here, we can see that 1.6 billion of their around $3 billion in revenue comes from commercial customers, while around 1 billion comes from the government. Now this is positive because that 1 billion revenue from the government is very stable, assuming that they don't lose any of these contracts with the government, and provides them with much more stability than a commercial airline who is always dependent on consumer demand. Now moving forward, let's take a look at the financial positioning of the company, and we can say that they're very stable. So looking at their historical capital structure, we can see that their debt to value levels have jumped between 30 to 50%, which is right within the optimal capital structure. And over 12 years, they've averaged a capital structure of 41%. Now this places them in a medium financial risk position because they're right in the middle of that 30 to 49% range. Moving forward, looking at their operating profit, we see that it's extremely stable at around 9%. And this is very beneficial to the company because their operating profit is predictable and allows management to make the best decisions for the company, knowing that they have very stable operating profit. Now looking down below, we'll see that the return on invested capital is less than the WACC, and this isn't great for the company because it means that they're investing in projects that are returning less than the industry average. So this is something you're going to want to watch out for and make sure that the management is either divesting from projects that are producing below average return on invested capital, and to make sure that they're not continually investing in projects that are going to return less than the weighted average cost of capital. So now that we know that the company has a stable financial position and has stable revenues, let's take a look at their valuation. Now I use an earnings power value and net asset value model to value all of my companies, and if you're interested in how I use these models, I have 3 free lessons on my channel which you should take a look at as I go over these models in detail. Now looking at Moog's earnings power value, we see that it's less than their net asset value model, and the reason why is because the return on invested capital is less than the weighted average cost of capital, so their earnings are going to be worth less than the asset value of the company. Now this leads us to an implied share price of $77 per share, and after a 33% margin of safety, you have an entry price of $52.07. Now no analysis is complete without risk analysis, so that's what we're going to look at next. There are 2 main risks for Moog which I've identified for you guys, and the first is that they've had a slight increase in their debt load over the last 2 quarters, which has brought the company near their maximum allowable debt load. Now this isn't necessarily negative or should deter you from investing in the company, but it's definitely something you should be watching, because if the company exceeds their maximum allowable debt load, that's going to leave them susceptible to bankruptcy risk. So that might be an indication that you want to get out of the stock if you see management making a decision like that. However, currently they haven't surpassed that debt load, and they haven't done it in the last 12 years. So right now I'm not worried about them reaching the maximum allowable amount, especially given the current situation we're in. Second is that Boeing represents 13% of their net revenues, and a decline in business with them could negatively impact the company's performance. Now, given how diversified their revenues are, this 13% isn't that significant, and additionally, they would be able to make up for any lost business with Boeing within their other markets. So now let's move on to the second stock, which is the Hexcel Corporation. We can see Hexcel dropped 71% compared to the 83% during the 2008 recession, and what Hexcel Corporation does is they're a leading supplier of advanced composite materials to the most technologically advanced sectors in the global economy. Now they primarily service 3 markets, which is commercial aerospace, space and defense, and industrial. Now if you take a look at Hexcel's revenues, they've had a very stable and strong growth rate over the last 10 years, and we can see that their primary revenue stream is coming from their composite materials, and this is where the majority of their R&D is going into. And what they're attempting to achieve is to make materials that are lighter, stronger, and more durable for these markets. And they've done a great job as they're regarded as one of the world leaders in this particular industry. Now, if we take a look at their revenues by geographic location, 53% of their revenues are coming from the United States, while 47% are coming from Europe or other. This gives them a great diversity of income from different countries and allows them to have more stable revenues in the long term. Now, moving on to their financial position, we see that over the last 12 years, they've averaged a capital structure of 34%, which is within the 30 to 49% optimal capital structure for this industry. This puts them at a low financial risk compared to Moog, who would have been in the medium financial risk, given that they had a little bit higher of an average capital structure. Now we can see that Hexcel has actually had an improving financial position as their average operating profit has risen from 9% all the way up to the high teens. And over this 12-year period, they've averaged 16%. This is in part due to the superior production and the legal monopolies they're able to create due to their patents. Now this is what leads them to having a return on invested capital greater than their weighted average cost of capital. And what that means is that the earnings power value of this company is going to be greater than that of the net asset value. And now when we look at the valuation, we see that that lines up, as the company's implied value per share based on the earnings power value model here on the far left is $59 per share, while the net asset value model returns $38 per share. Now for this company, we had to determine a sustainability value for the likelihood that the company will be able to sustain those supernormal profits. Now I chose a sustainability value of 50% because the company operates within a competitive industry and they're not the biggest player. So there's a likelihood that another competitor is going to come out with a superior product and take away some of their market share. So for that reason, I use 50% instead of 80 so that I don't overestimate the likelihood that they'll be able to continue operating at this level in the future. This led me to an implied share price of $49 per share and an entry price of $32.91. Now moving forward, looking at the risk for this company, this is actually something that deterred me from investing in the company myself, but it's something that you should look into yourself to see if you're comfortable with that risk. So 64% of the revenues come from Airbus and Boeing, which means that a deterioration of business with these two companies poses a very significant risk for Hexcel. Now, this is something that I personally wasn't comfortable enough with to invest in them. However, if you believe that Airbus and Boeing will be able to get through this period and will continue to operate as it would normally into the future, then absolutely Hexcel would be a great addition to your portfolio because they do produce supernormal profits and the company has great management who are great asset allocators. Now, the second risk is that a further deterioration of the commercial airline industry is going to negatively impact their future revenues. Since most of their revenues are coming from Boeing and Airbus, any sort of deterioration of the commercial airline industry is going to severely impact Hexcel's ability to produce profits into the future. So these are two risks that you should look into to make sure you're comfortable investing in Hexcel. So now let's take a look at the last pick, which is my personal favorite, Magellan Aerospace. Now, if you take a look, they dropped during the 2008 recession by 96% compared to the 71% that they've dropped currently. And the reason why is because during that 2007 to 2009 period, they actually weren't profitable and they had a much larger debt load. So that's something we're going to take a look at when we look at their financial positioning. However, for now, what you need to know is Magellan is a producer of integrated products to the aerospace industry worldwide. Now, they produce things like aero engines and aero structures. And if you take a look at their revenues, you see that they have a healthy growth trajectory to their revenues. Now, they have two primary segments. The first is the sale of goods, and the second is their services. Now, the sale of goods is their largest revenue generating segment. However, their service segment is what differentiates companies within this industry, because a company who's able to provide superior servicing to their parts is going to attract more business. And the reason why is because it's costly for a plane to be sidelined due to technical issues. So it's very important for the company producing the part to be able to come and service that part as quickly as possible. And Magellan has a great track record of under 4-day turnaround time for their servicing. Now, if you take a look at their revenue by geographic segment up above, you'll see that their largest geographic segment is Canada. And that's a great sign because Canada is a relatively small market compared to the United States or Europe. And that means that there's not going to be many competitors that are going to be coming into the Canadian market attempting to take away market share from Magellan. However, they're also diversified across the United States and Europe, which gives them more stability in terms of their revenues so that they're not dependent solely on the Canadian market. Now let's take a look at their financial position. You see that they're not only is it strong, but it's been improving over the past 12 years. If you take a look at what I was talking about, during 2007 to 2012, they had much more debt in their capital structure. And you can see that management has actively been reducing their capital structure. Now, looking at the optimal capital structure of 30 to 49%, which is the same as the past two companies we've looked at, they've achieved an average capital structure from 2013 to 2019 of 21%. And the reason why I've taken 2013 to 2019 is because management has shown that they want to reduce the capital structure of the company. So then I'm going to be assuming that they're going to maintain that capital structure into the future. Now, their average capital structure is below the optimal, which is a great sign because it gives them the ability to raise debt in the future if they have any liquidity problems. Now, taking a look at their operating profit, like I was saying, they weren't profitable from 2007 to 2009, but in 2010 they were able to achieve 8.7% operating profit margins, and they've maintained at least that or better from then. And since 2010, their average operating profit margin has been 10%, which is average for the manufacturing industry. Now, taking a look at the return on invested capital, it's within 5% of the weighted average cost of capital. The difference is 0.1%. So what that means is we're going to be looking at the earnings power value to be equal to the net asset value. And that's exactly what we see when we look at their valuation. Their earnings power value is worth $22.8 per share, while their net asset value is worth $21.3 per share. When you have a company that has return on invested capital equal to the WACC, or an earnings power value within 5% of the net asset value, then you just want to take the average of the two instead of using this formula down below. However, I still inputted it into the formula and it gave me a figure very close to the average of the two. So the implied share price for Magellan Aerospace is $22 per share. After applying a 33% margin of safety, you get an entry price of $14.81. And given that the stock is currently trading at around $6.20, that gives it over a 60% margin of safety, which is why it's my favorite pick out of the three stocks I'm showing today. Now, the risks faced by the company are that the supply chain issues could impact the business's ability to operate at normal levels, and that's something you should keep an eye out for from management's disclosures in press releases or in their quarterly reports. And the second is that a significant portion of their revenues are attributable to Boeing. And in the last quarter, their net revenues fell 15% due to issues with the MAX 8. But what's interesting about that is that only the US and Europe revenues were affected, and revenues from Canada actually grew. So the Canadian revenue streams are much more stable for Magellan compared to the US and Europe. However, a 15% hit to revenues is very significant, and this was only caused due to issues with the MAX 8, not the coronavirus. So you should be keeping a close eye out for any further issues that might come around with Boeing. However, because the company has such a large margin of safety over their implied share price, you can be fairly confident that these issues will be resolved in the future and the company will be able to maintain their normal operating profit levels. So that does it for this video. Just as a reminder, I'm not a financial advisor. All of my videos are based on my opinions, and you should not be making any investment decisions without doing your own due diligence. I'm here to share some opinions and maybe show you guys some things that you didn't think about yourselves. So I hope this was helpful, and I look forward to seeing you guys in my next video. Have a great rest of your week.